The exchange rate of one currency to another is always changing. For example, let's say on the 24th June 2024 during the day, the exchange rate of dollar to euro was 1.0686 USD to 1 euro. And on the 25th of June 2024, the exchange rate became 1.0734 USD to 1 euro. If you expected the rise in the exchange rate and you converted 10,000 USD to euro on the 24th of June, it will be about 9,316 euros. And on the 25th of June, if you converted the euro back to USD, you would get about $10,045. And that means you made a profit of about $45. When you convert one currency to another, you have engaged in forex trading. I am Asa Kennedy and I will be explaining what is forex trading and the basics of retail forex trading in this video. Forex is the short term for foreign exchange. That means forex trading means foreign exchange trading. When you expect an exchange rate to rise and you buy a currency, you have engaged in forex trading for speculative reasons. As a retail forex trader, you trade forex for speculative reasons to profit from small changes in exchange rate. In our example, after speculating about the rise in the exchange rate and holding euro for one day, you made a profit of $45 due to the increase in euro USD exchange rate. As a retail forex trader, this is how you aim to profit from trading forex. You buy a currency to hold it for a while, to sell it later and make profit from small changes in the exchange rate. Thanks to technology, today you can speculate the rise and fall in exchange rate from the comfort of your home, office or anywhere you are. You can do that with your phone, laptop or personal computer through Forex Brokers. A Forex Broker is a financial service company that provides traders access to a platform for buying and selling foreign currencies. Retail online forex trading is when you enter into a contract with your forex broker to speculate on whether the exchange rate of a currency pair will rise or fall. Either you or your broker will be right, and the winner pays the loser the amount the exchange rate has changed by. The forex market is open 24 hours, 5 days a week. So you can always speculate on the rise and fall in exchange rate from the comfort of your home or anywhere you find yourself. In forex trading, no currency is traded in isolation. Currencies are traded in pairs. Whenever you sell a currency, you buy another. And when you buy a currency, you sell another. Just like in our example, you sell USD to buy euros. And then you sold the euro again to buy back USD. The buying and selling of currency happens simultaneously. You must pair one currency with another and then speculate on whether one currency will rise and the other will fall. The currency on the left is called the base currency, while the currency on the right is called the quote currency. The base currency is always set to 1, while the quote currency is set to the exchange rate. For example, if the euro USD exchange rate is 1.07, it means that it will take 1.07 USD to buy 1 euro. In forex trading, you can profit from both rising and falling exchange rates. To profit from rising exchange rate, you enter the buy or long trade, and to profit from falling exchange rate, you enter the sell or short trade. Buy trades are placed when you anticipate the exchange rate of a currency to increase. The strategy in long trade is to buy low and sell high. Now let's look at an example of a long trade. If you expect that the euro USD exchange rate will rise, you enter a long trade. That means you buy euro USD. By buying euro USD, you are selling USD to buy euros. At an exchange rate of 1.07 USD to 1 euro, you buy 10,000 euros. Since you are selling USD to buy 10,000 euros at this exchange rate, you need 10,700 USD. Suppose after a period of time, the exchange rate changes to 1.1 USD to 1 euro. You decide to close the position by selling the 10,000 euros. The value in USD of 10,000 euros at the new exchange rate will be 10,000 multiplied by 1.1. So the USD euro will be 11,000 USD. Your profit will be the final value minus your initial capital. That will be your initial cost, which is 10,700 USD. Your final value, which is 11,000 USD. So your profit will be 11,000 USD minus 10,700 USD, which should be 300 USD. But if the market doesn't go in your favor and the exchange rate changes to 1.05 USD to 1 euro, you decide to close the position by selling the 10,000 euros. The value in USD of 10,000 euros at the new exchange rate will be 10,000 euros multiplied by 1.05 USD euro, which will be 10,500 USD. Your loss will be the final value minus your initial cost. So now let's calculate the loss. Your initial cost was 10,700 USD and your final value was 10,500 USD. So your loss will be 10,700 USD minus 10,500 USD, which will be 200 USD. To help you understand how you can trade the market in different directions, let us see an example of a short trade. If you expect the Euro USD exchange rate to fall, it means that you believe that the dollar will gain value against Euro. You go short on Euro USD. That means you sell Euro to buy USD. Let's say you sell 10,000 euros to buy USD at an exchange rate of 1.07 Euro USD. Suppose after a period of time, the exchange rate changes to 1.05 USD to 1 Euro. You can decide to close the position by buying back the 10,000 euros. The cost in USD to buy back 10,000 euros at the new rate will be 10,000 euros multiplied by 1.05 USD euro, which will be 10,500 USD. So you make a profit of 200 USD. So that means your initial proceeds is 10,700 USD and your buyback cost is 10,500 USD. So your profit will be 10,700 USD minus 10,500 USD, which will be 200 USD. The market can also go against you and the exchange rate increases. If this happens, you lose. As a forex trader, it is important that you understand how to analyze the market before entering the trade. There are two main types of market analysis in forex trading, that is fundamental analysis and technical analysis. Understanding both can help you make better trading decisions. First, let's talk about technical analysis. This method focuses on analyzing price charts and using historical data to predict future price movements. Technical analysts use tools like candlestick charts, moving averages, and indicators like the Relative Strength Index (RSI) and Bollinger Bands. They look for patterns and trends to determine when to enter or exit trades. In short, technical analysis is all about using past price data to find trends, patterns, and signals that can guide your trading decisions. It's like being a detective looking for clues in a chart. We have a playlist in this channel that will explain technical analysis in details. So now let's move on to fundamental analysis. This method involves evaluating the economic, social, and political factors that influence currency prices. Fundamental analysts look at indicators like GDP growth, interest rates, inflation, and employment data. They also pay attention to central bank policies and geopolitical events. For example, if the US Federal Reserve announces an interest rate hike, the US dollar might strengthen because higher interest rates attracts more investments. Fundamental analysis involves understanding how global events impact currency values. In essence, fundamental analysis is about looking at the big picture. It's like being an economist, predicting how various factors will affect the market. We also have a playlist on this channel that will help you understand fundamental analysis in details. Let's talk about contracts for difference, CFDs. Retail forex trading is done through contracts for difference. As a retail online forex trader, you do not own the asset. When you sell USD for euros, the broker does not deliver the euros to your account. But by speculating, you profit from the change in exchange rate. This is called contract for difference, CFD. A contract for difference, CFD, is a financial derivative that allows traders to speculate on the price movement of various assets without actually owning the underlying asset. The profit you make is the difference between the opening and closing price. Like in our Euro USD example, where your initial capital, which is your opening position, was 10,700 USD and your final value, which is your closing position, was 11,000 USD and you made a profit of $300. In a future video, we will explain CFD in details. But for now, you should know that CFD trade is risky because they are leverage, and you should know how the market works and how to take risk. See you in the next video.